Okay, I think in the interest of time, we can start now. So we covered climate change and monetary policy. The focus of this panel is going to be financial regulation and supervision and climate change. I think some of the issues already came up in the context of discussion of monetary policy, but we'll dig deeper into this. So the way we're going to organize it is I'm going to give the speakers somewhere between 5 and 10 minutes, given in the interest of time, if you can be maybe 7 or 8 minutes, and then we will start the discussion. I'll raise a couple of basic questions up front, and then we'll open it up to everyone in the room. Okay? So, Paul, you have the floor.
Thanks, Sunil, and thanks for the invitation to come share with you some of the work we've been doing in Europe. So to be fair, I'm going to talk now about the prudential angle. I think that was actually touched upon more than I expected in the previous panel, with some questions about capital adequacy, risk management, and the like. And so indeed, prudential always then relates back to risk. So what I'd like to do in my opening remarks is talk a bit about the analytical insights we've gleaned from really getting into data. And I think what's true is when you look around this room or even outside this room, many people are everyone I'd say has a very strong prior about climate and what we should do about climate change. But I think our goal was to try and bring more data, more information to that debate, such that we can all have a posterior which is very well informed, regardless of our prior. And I'm going to talk here really about the work we've been doing on the macroprudential or financial stability space. Now, I can talk about a variety of other things we were doing in the Q&A, but let me focus on that for now. And basically, I wanted to do the following. To talk about 3 different aspects. So one is, where do we see that the risks are resident when we start looking into very granular data sets? The second thing I look at is how and when might those risks materialize? How do we model these risks? And to think about the paradigm of a backward-looking, back-tested approach to risk might not be appropriate here. We need to look forward. This is a structural break. And third would be to talk about what are the prudential implications, prudential policy and notably macroprudential policy, of the insights we glean from the analytics. So let me start with the where. So on the side of the where, and here you can think about when I'm talking about the where and how and when, you can think prudential policy, macroprudential policy often has these 2 dimensions. One related to the cross-section, so how risk is effectively propagates in the case of stress. And one is a time series, how risk builds up. And that's basically what I'm going to hint at when I get to the prudential questions, to sort of give you a bit of a teaser. So on the side of the where, what we have here is obviously thinking about physical risk and transition risk. When you start to get into very granular mapping, so address level firms, what is it we can see in terms of the distribution of exposures of financial sector in Europe that I'm going to speak to? And I think what we saw when we started looking into the data were some surprising things. One of them was when you look across physical risk hazards, and there are many of them, so we talked about wildfires this morning, heat stress, water stress, storms and the like, floods. What we see is any individual hazard might not be necessarily that important for the exposures. Maybe floods is a bit more relevant in Europe, riverine floods and the rest, on aggregate. But when you start looking into the detail, what you see is actually, first, it tends to be distributed across countries in a very uneven way, and even within countries. So you really need to look in this fine, granular physical risk mapping, who is impacted and where, to understand what exposures might be at risk. Up to 50% of firms in parts of Europe, in certain countries, are exposed to wildfire risk or heat and water stress. This is very real for them. And I think the next thing we found out is when you look at banks' exposures to this, are even around 1/3 of banking sector exposures, lending exposures, tend to be areas which over the next 20 years could experience some form of physical risk. And not any individual hazard, but compound hazards. Those hazards have an interplay element. They're likely not to be independent. Water stress would become, flooding is an integral part of this on one side, on the hydrological side. But also you have this element of heat stress, wildfires are integrally related. And they are self-reinforcing and mutually reinforcing in many respects. So that was the first thing we noticed was on the physical risk side was that. Now, sometimes we get to the point from many people, yes, these are gross exposures. What are the net exposures? The question is, the insurance of these actually we would have thought is relatively sound. When we look more into actually what's being insured, only around 1/4 of these exposures is actually insured for a developed market like Europe, which gave us some pause for thought. That's only going to become worse with time. the availability or the cost of that insurance. That's on the physical risk side. Let me just briefly talk about the transition risk side, where we saw that they're also interesting when we triage firms into ones which are highly carbon emitting and ones which are not. And we saw that in general, banks tend to be more resident, up to 2/3 of their lending exposures, towards high carbon emitting firms. That's not changing much through time. Versus if you look at investment funds or insurance companies and pension funds, they seem to be more actively managing the securities exposure, but it still remains around 1/3 of the total. So the financial system, by and large, has a big exposure to transition risk. And banks in particular are exposed to high-emitting firms in a very big way. And if you think about the importance of climate change in terms of generating shocks going down the road, one of the questions will be how are greening firms, not ones which are ostensibly already green, influencing risk. And so banks will have to manage that transition. They're going to be an integral part of that. Now, when I talk about financial risk, just one question on exposures is when you go to financial risk, you have to think about potential amplifications. Overlapping portfolios is going to be a key one when you think about banks, insurance companies, pension funds, or investment funds, mutual funds. They're all going to have basically this idea we had this morning. Everyone wants to sell at the same time. So this idea when you all run for the fire exit at the same time, and maybe individually rational, but system-wide, it's going to be a disaster. You know? I think the second thing is this a part about counterparty cascades. So you can have this issue whereby one firm collapses. It's usually not in isolation. These tend to be ones we have through value chains or through financial linkages, other firms also collapsing. And we've been seeing that's potentially much more important than we might think through simulations. And last is this idea I talked earlier about compound hazard shocks. Hazards are unlikely, and salience means you're probably going to see transition risk intensifying in terms of policy or technology or sentiment, precisely when physical risk is starting to become more salient. There's a salience bias, which in parts, sort of bias to all of us in the system. With that in mind, the second thing is how and when might these things materialize, these climate shocks. Our idea was thinking about the physical risk, transition risk are related, and they're trading off. So with time, what we found is the following. Through stress testing exercises with a horizon which goes beyond what we normally look at, 3 to 5 years, but into the decades or horizon space. What we saw is that, of course, initially, you're probably like a bit like a J-curve. Transition risk will be dominant in terms of losses. Small losses, maybe, as you have some churn and sectoral reallocations. But with time, this will give rise to physical risks, which are linearly increasing. So there's this trade-off, this intertemporal trade-off that we have to face. Of course, that's the heart of a lot of the inaction bias we're seeing currently when it comes to dealing with climate change. And it's bringing those expectation shocks back to the present. Financial markets can and do very quickly adapt their expectations. And as such, you can have big shocks occurring very, very quickly. Now, with that idea, there's that. Then the other thing, I think, with the composition that I mentioned earlier, you're likely to see a lot of frictions along the way. So this reallocation might not be smooth. And lastly, of course, what risk materializes. So market risk, in our view, and when we looked at the data, tried to run these through simulation models, tended to be one which comes up quickly. Financial markets do have forward-looking, whether it's equities or bonds, approaches, and then they bring it back in terms of market pricing shocks, which then will slowly bleed into credit risk, if you will. There's this idea of where is the risk going to show up, how that financial risk materialize, was very much informed by these simulation exercises. And I think what we took away from this in a nutshell is it's going to be a bumpy ride. It's not going to be one which is smooth and linear. Now, with these points in mind, what about the prudential policy? And this is ultimately about the panel. I'm going to tee it up a bit for my fellow panelists here in terms of the policy mix, but let me just talk quickly about a couple of things. So one is in that constellation I've mentioned, obviously it's a complex problem. Policies have the complex response is needed. And each institution looking at their mandate, or supervisor or regulator, has to think about what would be the important thing to look at. I think our concern is that a system-wide approach means there may be some triage. So certain regulators or supervisors might need to look at certain questions. The insurance one I mentioned earlier is one where you think about that's a potentially one insurance protection gap for insurers to look at, or sovereigns to look at in conjunction with insurers, as they're probably going to be the ones left with the bill of physical risk hazards actually materializing in a way ex post, which ex ante could be better managed. Or when it comes to the question of banks, how do they manage these transition risks, which they need to actually bring down their emission, they have high exposures to emitting firms. How with time are they going to manage those sorts of emissions? And exposure to these high-emitting firms. And with that in mind, of course, industrial policy will deal with a lot of the questions of what's going on under the hood. Fiscal policy. Prudential policy does, however, have to deal with the risk. And the macroprudential approach is going to need to do two things. One is it's going to need to think about these potential for amplification. So focus on safety and soundness of individual institutions might not give you the full picture. It's the interactions which matter. Two is this idea that it's system-wide, and the risk somewhere in the system is going to be showing up. So just focusing exclusively on one narrow part of the system might not be sufficient. How this interplay will occur through time. With this in mind, I think that the big reflection we've been having, and actually James is now gone, but I mentioned the Bank of England had some influential thinking here. Where is our prudential and supervisory approach lacking in two respects? One is, are we not measuring the right things or approaching this with the right questions? So are we looking too much to backward-looking, back-testing of data to think about devising potential remedies? And is the horizon sufficiently nuanced or long enough to think about the potential trade-offs? On the side also then of also gaps which are in the regime as such, do our toolkits have what is needed to handle climate change in addition to other traditional shocks? So I think that the current thinking is largely that they do. So if you adapt the current toolkit, it's not as bad as one might think. There are tools which are amenable to this, and you don't have to throw out the baby with the bathwater. Climate change should show up as market risk, liquidity risk, credit risk, reputational operational risk, much the same way as other risk categories do. The key question is going to be, will it show up in different ways, which are not well equipped with the toolkit we have. And I think just to leave it before I go to the next panelist, it's just basically the ideas we have with the following when we think about available instruments in our toolkits. One is on the lender side, so banks in particular. They can deal with the question of absolute risk, so more capital to deal with unanticipated shortfalls, and we discussed that this morning, or relative risk. Are there some sectors, some firms which might be adapting at different paces, and risk might materialize physically in transition through time? Two is on the borrower side. What about borrower-based measures? So households or firms, not just the lenders themselves, you might think about insulating them from losses given any default. Third would be the idea about the market side. So more information is clearly going to be better in terms of helping to inform decision-making and risk management. And lastly is going to be on the side of insurance. Can we insure these shocks in a way which helps to also mitigate them ex ante? I'll leave it at that for now. Pass back to you.
Great. So thanks very much, Paul, for laying out the terrain in some sense. Sarah, you want to take off from there?
I sure do. I'm going to start with the scary part and hopefully end on the optimistic part because that's my soul. But the U.S. is just behind. Everything you said is just, you're way ahead in so many places. And that's a very frightening place to be because the Fed is moving slow. But I'm also going to go for how we focus on the mission and mandates of the institutions to really get them moving forward faster. So we don't think of this as a separate crisis, but how do we really integrate it into their own work? And that climate really is just another risk. You mentioned that as well. And then also the positive part we'll end on is the virtuous cycle. So much of this we're behind on, but as you were describing, as you start diving into the data, you see it. You see it, and then it builds upon itself. So maybe it starts as an abstract exercise because someone tells you climate maybe matters, but I feel very confident as you dive into the data, as you really get into banks and supervise them, you see this information and then they will build. So a little bit more to focus on this idea of mission and mandates. Lots of people have mentioned it. I'll probably also go a little bit into monetary policy since the first panel went into our area. I'll also go into theirs a little. But it's a little different in the US, UK, and Europe. So in the US, we are well, I'll say it the positive way. UK and EU have the secondary goal of supporting the government's policies. The US does not have that. In fact, it's quite explicitly, they love to say, we don't pick winners and losers. So that can seem like that's a bad thing, but it just means it's a different framing and it's a different way you need to talk about it. So I think some people say, well, that's just a cop-out. I don't think it is a cop-out. It is the way they operate, and that still leaves a million ways to talk about climate change, really connecting with that mission and mandate. So having people who know even more than I do about all of these institutions is essential in these conversations. They aren't random existential crisis, what should the Fed do? They're what are the Fed's tools? What's their mission and mandate? What do they do? How do they operate? How do they talk? talk. How do we really get them to move is really going to be based in how they talk about the issues rather than trying to pull them to our world. Let's try and meet them in their world. And this data conversation is a perfect one. The liquidity risk, the credit risk, that was the first thing that we did when we were trying to ask for supervisory guidance is, this isn't that new and different. So that's that second one. The climate is just another risk. So I really, in my ideal world, will not actually have climate be some totally different thing in all of these different entities. Instead, it'll be integrated without. Almost everyone's job needs to consider climate. Obviously, we'll need different experts. I don't want to claim everyone should be a generalist, but it's not some separate thing. So this really relates to where we're starting in the US. We're behind. So supervision and regulation in the microprudential, the individual institutions, is largely where you're saying you began, and that's where we are. We're starting to go towards the macroprudential with these pilots for the scenario analysis, but it is that idea of really understanding that risk first. It's the easiest for politicians and or the hardest for them to disagree with. This is just saying, hey, it's another risk. We just need to consider it. Alex and I talked about one we've each used in this example is cybersecurity. It used to not be a thing. It is a thing. That's not because the mandate changed of the institutions whatsoever. It's just that cybersecurity is now a real risk for banks. So they need to integrate that. And I consider climate the same thing. It's not something different. It's not a new mandate. It just is a different new risk that now they need to include. So this is the part where I'll kind of go on down the line a little bit, that this is where you begin, is that supervision regulation, the macroprudential, but there are the different parts. So for the Fed, monetary policy being a major one, how can you consider price stability and jobs without considering it is another version. Is it a totally separate thing? No, but people who are worried about price stability need to be worried about climate. Now you need specialists to do that, but you also don't need it to be separate. So I think that's that question too, that we talk about the mission and mandate and how it fits in there, but also that this is just another risk. This is not something that crazy different. We don't know all the answers and we need to be moving forward. And that's the virtuous cycle part. I really am happy sometimes with starting small because I think it's one of those issues that if you see climate risk, you never unsee it. And you're going to see it in a lot more places. So that was part of why we really pushed for this beginning of supervisory guidance in order to start integrating it into the microprudential. Because it's one thing when an environmental organization like NRDC says, there's lots of risk in the banks. It's a lot different when the individual supervisors, the people going into the banks, go and they have to do this thing they might not think makes sense, but they see the risk. And then all of it starts feeding into the data. And hopefully all staff at different levels start doing this. So that's where I do view there's a virtuous cycle. And a lot could happen quickly. In the Fed, they have a lot of economists. So once they put their mind to it, I think that they can move much faster. Though as an institution, they don't tend to be the fastest, so that's a whole nother thing. But I think us talking more about it in this version of we see a 2008 style level crisis that could happen, and we know it could happen, and if we do nothing about it, this is dereliction of duty. So really talking about that this is something that's coming and we see it and we need to learn more, but we need to not wait until afterwards. And the reason I really emphasize this as well is in 2008, it was based on the mortgage industry. We didn't want the mortgage industry to die. So all parts of government, including the Fed, dumped billions and trillions of dollars into the mortgage market to make sure it survived. Well, let's just say it is this, everyone rushes to sell their fossil fuel-based assets at one time. We don't want to bail them out. We don't want them to last forever. We don't want them to fail overnight and cause crazy financial crisis, but I think we'll be in a really complicated place if we wait until there is a crisis and there are all these fossil assets and no one is prepared for it and it takes down the financial system. What do we do? So a much better answer is in advance, start understanding where that risk and start acting on it and having banks start prepared. And something that we can maybe even talk a little bit about later is that some of these preparations will happen by just the regulators asking some questions. So I want to go deep and I want to have all sorts of rules and I want models, but I'm also just excited for banks to just start talking about it and start integrating it as early as possible before we're at those moments when everybody comes to sell.
So thanks very much for the virtuous cycle and also saying that we should try to limit future moral hazard by beginning the conversation now. And I think that's very important, and we'll come back to that again. With that, Mark,
I suppose it's not enough for me just to say I agree with everything Sarah and Paul said. Just maybe as a piece of background, I wouldn't portray myself as a climate expert. I have long experience in bank supervision, both in the practice of it and in policy development and implementation. And then I have a keen interest in these climate issues. So that's the lens that I'm bringing to this, which maybe complements what other panelists are bringing. I think I can probably say three things. One is, I think the focus on what should be done with capital regulation to reflect climate is probably not the most important focus for the discussion right now, and I'll talk a little bit about why. Happy to talk about it. Actually, I've spent most of my career working on capital-related issues, so I'd love it if that was the issue, but I don't think it is. The second is, what is the issue? What is the thing to talk about is what I would call the supervisory process, and its focus on risk management and on being able to recognize these risks and appropriately reflect them. And then third, to talk, I think, what are two of the most important things to support a good supervisory process right now. One, Paul, you mentioned this quite a bit, of course, scenario analysis and refining that and making that more productive. And I think underlying scenario analysis, there's an important layer of what I'd call infrastructure, data infrastructure, modeling. And there's so much work to be done so productively on that right now. I think that's a good place to have the focus. So let me just briefly, and Sunil, you'll have to cut me off if I go beyond the 5 minutes that you're looking for. I know you will.
7 or 8 is fine.
Okay. So I don't think that capital is the right place to focus. I think it's actually way more complex. Whenever I start to have these conversations with people, what should be done in regulation, it's almost the first thing everyone brings up is, well, we need to talk about how to change capital. We need to have more capital. We need to have higher risk weights on certain things. There's actually a really good working paper on that I saw late last year. It's by Holscher, Styro, and a couple of other co-authors. I apologize if they're here and I can't remember their names. But it's a really great paper about how to reflect climate in capital standards. And it goes into all of the issues and develops it in a fairly neutral, balanced way, but it becomes clear pretty quickly that there's a lot of subtle complexity if you want to think about it, about what should be done with capital standards, and they, I think, lay out the issues very well. But one of the takeaways from it is, if you think about the intent of capital standards, it's to protect against unexpected events that are non-diversifiable and occur over the next horizon of, it's hard to say, but maybe 1 to 3 or 4 years. And so then if you start to think about that in a climate context, the question is, what's going to happen that's unexpected and non-diversifiable in that horizon? And I'm not saying there aren't things, there are, but those are the things to focus on, not to say, climate's gonna be a big deal, therefore banks have to hold a lot more capital, because there's more work to be done to establish exactly what we mean by that. I think we've mentioned it here in this meeting a few times. What does matter is expectations, and as you think about transitions, expectations could either change slowly and gradually, or they could change suddenly, abruptly, and materially, and that's going to have an effect on risk, probably the kinds of risks that capital should protect against. That's mostly market-related, though. It's market risk, and while that's important, it's not the major risk that most banks face, and it's also not the one, when I get into conversations about what risk weights should be, that doesn't apply to market risk at all. The market risk framework is different. So that's to say, I don't want to focus on that. What I would distinguish between regulation and supervision. The capital regulation is about how much the capital should be. But there's this other piece, and in the Basel framework, it's referred to as Pillar 2. I think wrongly people come to think of that as just, it's an additional add-on to the minimum. It really is a statement that there's much more to capital adequacy than just how much how much capital banks hold. And if I had a whiteboard here, you would see me writing on it, and I would draw something like a bell curve type distribution and say, there's the outcomes for banks, and over here in the tail, there's a line, and that's capital, and we want to limit the probability that the bank's going to fail by blowing through its capital. Great. All this discussion about risk weighting and so on is about where that line should be, but not about this distribution. And most of supervision then is about what is that distribution like. It depends partly on exogenous risk factors, depends to a large extent on banks' portfolio choices, but also importantly depends on a lot of subtle management choices that banks make in managing their risks. So it's not very sexy stuff, it's pretty boring. It's what kinds of internal controls do they have? Do they have the right policies and procedures? Do they have the right corporate governance? Things like that really matter to that. And so to talk about how to set the capital ratio absent these other things is really not, I think, not getting the full picture, and in my view, not the right place to start. So and Sarah was talking about, you made me think of this, that we need to get banks to recognize that climate risk is a risk and should be managed like other risks. And banks have a lot of experience with risk management. So what they need to do and what bank supervisors need to do is make sure that the focus shifts to saying, all right, it's a risk. Now let's think through risk management. What do we do here? And the thing I thought of was, after the great financial crisis, there was a lot of focus on models. And here in the US, the regulators focused on model risk management, on saying, okay, models can be a source of risk. You need to manage that. Banks, you need to manage that. And they developed a set of principles and guidance that honestly fundamentally changed the way models and model risk is managed in the US. It's really pretty remarkable. And I think that same process could apply here when we turn to climate. So in that regard, I think one of the useful things that supervisors have done is develop statements of principles. And I think some people see these as, oh, that's just stuff on paper. What does that matter? But it really does matter, because if you say we need banks to manage their climate risk, need to get specific about what that means. So the Basel Committee has done a good job developing principles. The US regulators have all developed draft statements of principles. OSFI in Canada has done that. HKMA in Hong Kong has guidance that they've put out. The ECB has put out guidance. So there are a lot of these now that articulate, when we say manage climate risk, what do we mean? What should banks do? And I think that's given the state of development, that's the right place to be focused. Those statements of principles, all of them, I've done side-by-side comparisons, all of them focus on stress testing or scenario analysis as one of the tools that will be important. And I think that's the right emphasis. I know it's difficult to do this, to do these, but I think we've brought this up a few times. Just need to get started and start learning how to do this. I know you need to develop good scenarios, you need good models to link to results. One of the things that I think is neglected in scenario analysis sometimes is the presentation of the results in some way that's actionable. So how do we produce something from these scenario analyses? I also think there's a distinction between scenario analyses and stress tests. I know the EPSOC has made this distinction. I think it's scenarios are the thing that we need right now. We need a broader range rather than to say, let's pick a single stress scenario and see where it goes. The other thing, and we can talk about this more in the discussion, but stress tests typically assume no dynamic response by institutions, by borrowers, by anybody. And that's clearly not a good way to think about climate risk over the horizons that we're talking about. We need to build dynamics into these scenarios. Scenarios is the way to do that. What will we get out of those scenarios? I think it will support a general recognition of what banks need to do additional work internally in their risk aggregation, in the collection of information, in just roles and responsibilities within these banks. I'm far more optimistic than Sarah Bloom-Raskin was about what the Fed is doing. We could talk more about it, but I think it's actually going to turn out to be a pretty useful exercise. One thing that I think will come out of exercises like that, though, and I think we would all see this, is a need for better data in an organized way. And this, it sounds, I don't know, maybe it doesn't sound that significant, but now I guess it's going to sound a little old. I've been down this track before. We come up with some new tool that's going to be useful in supervision and regulation, and it makes perfect sense when we lay it out, but the data to be able to implement it, you think of it and you think, okay, well, the data, those must exist. It must be possible to do that. And then you start trying to implement it and you find out that, yeah, the data exists, but they're only on paper and they're in file boxes in a warehouse in the middle of New Jersey, and somebody has to go out there and get it and digitize it if it's going to be useful. And I don't know what that New Jersey example will look like in this case, but I know that the way to turn up the problems with the data is to start trying. So I bet all of this is going to come up more in the discussion. I'm going to stop there.
Okay, so
back to you.
Mark, thanks very much for discussing capital regulation, the emphasis on the supervisory process, and then giving us your views on scenario analysis. So let me try and frame the rest of the discussion by raising a set of issues that I think have been coming through. There's going to be a lot of uncertainty. We don't have a lot of historical experience with climate data. So data collection, data infrastructure is an obvious question to hit. The next set of issues comes to what Sarah raised in the morning about being threat agnostic and threat specific. When we start discussing macroprudential rules and policy, we have basically we're using microprudential rules with overlays. So in some sense, we have to be both threat agnostic and threat specific in some sense, because when you start designing macroprudential policy, you have to define what these overlays are, and you have to have some way of triggering them, right? That brings me to the next issue regarding macro-pru, is that the discussion we've been having here, macro-pru has to be in some sense forward-looking, because in some sense we want to, in some sense, diffuse systemic risks which we think may be rising in some ways, either because of the climate transition or because of our physical production consumption transition. The next set of issues I think has been raised here is a lot of the risks today are in the non-bank financial system. We've been focused on banks, but we have to focus on the system as it is, where we have banks, we have markets, and we have complex interactions. And we don't fully have a handle on how to handle those interactions as the current stress in the banking system reveals. So let's start with that. It's deep uncertainty. We need, I would think intuitively, we need bigger buffers. The question is, how do you, in some sense, calibrate these bigger buffers and justify and trigger them when needed? So that's a big question we can start with, and then I'll take up the next set of questions.
No, but with the idea of buffers, so I think, look, part of our question is, do you need more capital necessarily initially up front, or the risk management strategies that we can also already analyze, which could be quite effective? And I think already Sarah's spoken to some of these. No? I think part of the big question first is awareness. No? And I think we see this through climate change and banks, through Alcoholics Anonymous. Awareness is the first step. No? You need to be aware of the problem before you actually deal with it. No? Understand the problem, gauge its complexity, and then look at what potential measures you take. With that, we've been treating it as a bit of a symbiotic exercise, whereby we have bottom-up exercises. We go and talk to institutions. We ask them, like the Fed exercise is doing, or the initial Bank of England one. What are you seeing? What is actually happening on the ground? What are you missing? What are some of the elements you would need? How do you do materiality assessments? What are the specifics you need to dig into, and what's actually lacking? That process, and also building awareness in terms of business model challenges. What is our long-term challenge to our business model, which we need to think about in terms of operating our business, is something which is very much inherent and embedded in the micro-prudential aspects. So what's going on in individual institutions? And I think that's very much part and parcel of what we need. Layer that on top, we have the top-down stuff, which is a lot of what I was talking about now. So models which also analyze questions of if we all hold the same exposures, and we assume, which I often hear from the sector, we have exposures, but we'll go for the exit point when we need to. Our corporate bond portfolio is a 4 to 7 year horizon. So our maturity on that portfolio is such that it effectively is not a problem by the time we have to think about offloading. Well, you can see there are questions like the Silicon Valley Bank, which happened recently, where expectations can really bring forward sometimes things which you would have thought had a long duration actually end up being quite immediate. So to your question, Sunil, on non-banks, just to quickly talk about this. So if the view is that we've seen over time that it seems to be that market risk will probably be the first place climate risk will be manifesting itself before it gets into credit risk questions, we would see market risk really very much resident in who holds securities, bonds, equities, exposures through derivatives to the system. And that's going to be largely mutual funds and long investors, insurance companies, pension funds, less banks. So we need to think about what will their activity be generating? What will that imply for collateral values? How will that feed back necessarily onto other lending sectors? So I think with all of this in mind, it needs to be a holistic approach, thinking about these questions before we go to, I think about buffers and specifics. There's a triage question, should insurers also be dealing with part of the question on physical risk? Should transition risk also be resident there? Maybe more banks. So there's a triage question. There's a question about who should be also ultimately basically taking what action, and should that involve necessarily risk management versus capital or not? These are still relatively open questions, but the dialogue is advancing quickly. And I think with time, we have set a 2024 deadline for banks to come back to us showing they've complied with supervisory guidance. We set out in 2020 and clarified in 2022. So there's a timetable associated with this that's very clear. And if by the end of that timetable there are certain laggards, we'll be looking also to insulate them against risk. So that point is coming rather soon.
I would just love to, I think what you were saying, but just to say it more clearly, I think ideally we give them these pushes and they shift. So they don't need as much capital buffers because they actually are working to manage their risk in many different ways, including buildings themselves can become more resilient. It's just an example. So as banks are, so rather than just being like, oh, just do a lot of capital, that actually doesn't incent much change in behavior. Instead, let's say, okay, try and do your change in behavior. And now if you don't, and we still see the risk, we have this stick on the side that we can use for you, rather than just being like blanket capital and then no one changes anything.
And I like both those comments. I'm going to link your 2 points together: the deep uncertainty and this issue of do we need bigger buffers? So, as I see this is part of the reason I really like scenario analysis, because I think in this particular current environment where we have this, as you framed it, deep uncertainty about all these potential paths that we could follow, and we really don't know much about which one we're going to take. We will take one of them, but we just don't know which one. And that's why stress tests that rely on the identification of one particular scenario or maybe two are not as valuable as a high number of scenarios, multiple scenarios that kind of span the space. And we have it's like a very diffuse prior. It's that we kind of assign equal probabilities to all these, or we just don't know enough to assign any probabilities to them. So I think the thing to do is to run these scenarios, and over time we'll refine our expectations about which of those particular paths will eventuate. But we think through the implications of all of them and do contingency planning. And so this is where I think it links to the comment you were just making, Sarah, about they will adjust over time. Looking at all those scenarios will help banks think through what types of portfolio adjustments, what types of changes in their business strategy will insulate them against the bad outcomes that they see in those various scenarios. And in fact, if they develop the tools, it'll allow them to explore it, to say, okay, well, what if we move in this amount out of this sector? What does that do for us on these various paths? But until they develop the capability to do that, they can't do it. They can't even really start thinking about it in a sensible way. I think there may be a need for buffers, but I'm not convinced yet. So they probably a little bit, but not the big thing.
Great, thanks. So let me follow up that with a question which I think is both relevant to monetary policy as well as financial regulation and supervision. And this, I think, was controversial in the past, but all central banks, given what we've gone through in the last decade and a half, do it. And it's that if you're in an environment of deep uncertainty and we don't know what might transpire, to what extent should central banks provide forward guidance? Because forward guidance then, in a sense, tends to absorb uncertainty, if you know what I mean. And if it's a truly uncertain environment, to what extent should forward guidance be provided by the central bank? When I think about it broadly, you want to have some diversity of opinions, and that should provide incentives for you to think really hard about it. And it's the diversity of opinion that leads to market formation. Some gain, some lose. There is liquidity. There is no liquidity when we all agree on everything. So the whole question of forward guidance and how do you, in some sense, provide guidance to the system. And this is related to the whole tragedy of the horizon that we are discussing, that this is a long-term issue which is emerging, but at the same time we're going to have explosions every now and then which might lead to stress. So that's the context in which I asked the question, because it is reasonably specific. And also complicates modeling, which I'll come to next.
I can kick it off very quickly this way. So look, central banks in the unconventional monetary policy space were often doing two things. One was signaling and one was portfolio rebalancing as part, and that governed the efficacy of these interventions. And I think in this space it's very much the same. So signaling, in a sense, is one about information dissemination, which we're very actively doing, trying to communicate learnings as we go along the way, and communicate with the institutions we supervise and regulate to ensure that they're embedding good risk management and understand our expectations, and we can also set standards. So in a sense, that has a very powerful role, even before you get to the portfolio rebalancing. So do we get into tilting, which we've preferred over exclusion-based measures, and trying to think about possibly implementing means of ratcheting up through time requirements as we see laggards, as they're adapting, they're adjusting. Maybe the ones which are doing so insufficiently, they also have carrots and sticks.
I can go next. I mean, there's a part of me that says, always there's a lot of uncertainty. So what's so different now? I mean, we maybe know what the uncertainty is versus something that comes out of nowhere, so that provides us more certainty. And then there's actually, Fed does a webinar series. It's the economists, and they're really diving into things. And I think it was Lars Peter Anderson at University of Chicago, Nobel laureate, and he's doing this whole thing about uncertainty in central banks. Uncertainty, uncertainty, uncertainty. And he stops halfway through and he says, but wait, I want to be very clear. I don't think that means we don't act. We have a lot of uncertainty, but we need to start before. And I thought it was interesting that it wasn't like totally part of the presentation, but he just kind of realized the way he was talking about uncertainty, it could make it seem like you don't do something. And he was saying, no, it's the exact opposite. We're uncertain, but we know something. So we have to start. And that's how we'll learn more and we'll improve. So I give that same answer in this. It doesn't mean you don't do it. You are very honest about what you know and you don't know, and you could be very clear. And I think that messaging piece is extremely important for all of the central banks. That's a really strong tool that they can put out there, but I think you need to do it. I don't think that means you don't.
Interesting. So, and I would say, taking it down to the microprudential level, I think the equivalent of forward guidance in microprudential is the dialogue that goes on between bank examiners or other supervisors and the institutions that they're supervising. And it's amazing, I mean, it always surprises me how much gets communicated in a variety of ways. So as central banks and as bank supervisors learn more about climate and have views about what should be done, that's the way it will be communicated, and it will be more influential, I think, than is often thought. It's amazing how often I have do some work with banks, and they spend a lot of time trying to guess what the bank examiners are going to be interested in next time they come. And then they try to take actions to anticipate that. And I think that's the equivalent of forward guidance.
I mean, the reason why I just asked the question was also because MacroPro is concerned with systemic risk. And if we are worried that all of us will try to do the same thing at the same time, and if providing forward guidance decreases the diversity of actions that are taken prior to the event, that may have some implications for how things play out.
And I'd take it somewhat the opposite. The more you talk about it early, then maybe some people start rebalancing earlier. They start taking actions earlier instead of waiting till the moment where I can be the last one to sell, or whatever the quote was. So I think the more we talk about it, we will get an orderly transition. So I think it's the silence, the not trying to guide it, that will lead us to actually doing more of the same. Will be a herd mentality because no one will have thought about it, and then they'll all think about it once and everyone's gonna go sell. Versus like starting now, I think you'll start having it be more orderly, and the people will realize the things they own on their balance sheet aren't this perfect liquid asset that's going to be able to be sold whenever they want. So either they'll get rid of it or they'll just be aware of it, and they hopefully would manage their portfolio around not needing to.
This also leads up to the other question that came up earlier when we discussed about targeting facilities, right? I mean, the reaction we've seen over the last decade is that ex post, after the crisis occurred, we've created an alphabet soup of facilities to address the issues that have arisen. Even the facilities that Sarah was mentioning in the morning about created after SVB. So that's related to this whole issue in the sense that if I convey to the system that no matter what happens, I will be there with some facility, that creates a dynamic which may be difficult to manage, both ex ante and ex post. Any thoughts? I know these are very difficult questions, and after this I'm going to lead into the question of institutional design, but any thoughts on that?
So I think Sarah talked to this idea of leaning versus cleaning. And I think one of the things we found in the 2007-08 global financial crisis episode was that the cost of cleaning up far exceeded the cost of leaning into something in advance and making awareness very strong, no? Either through supervisory channels or through other channels. So I think there's a big thing to be said about ex-ante management, particularly for what climate is ultimately a foreseeable shock. We know it's coming. The deep uncertainty relates partly to how it will arise. But the fact that it will arise is known. And actually, I think the insight we gleaned from talking to climate scientists, the Intergovernmental Panel on Climate Change just last week released another report. And what we see in that report is 1.1 degrees of warming is in the baseline. That's not a risk. So this is already cooked into environmental science and will not go away. So the fact is we're probably reaching these tipping points rather soon. And with that in mind, I think, again, awareness, I think, will breed a lot of preparation such that leaning will then obviate the need for lots of cleaning and further adding to the alphabet soup, or maybe leveraging the alphabet soup in place.
I'd also say that we've been weakening regulations for a while. So I think there's lots of space, especially in the wake of SVB, to be strengthening oversight in general, with climate being one of the things you're adding, so that you can be telling the banks earlier, we expect you to do this, and we will perhaps even get harsh with you, but you were talking about it. Was this coming as at least one effort to try and avoid that moral hazard? It's not. Still, some people, I'm sure, they'll assume they're going to be bailed out, but the more you're doing it on the front end and you are strengthening regulations overall rather than weakening.
I do worry a little bit about the fact that so much credit is now intermediated outside of the banking system, particularly in the US. I mean, I think the latest numbers that I've seen, it's sort of banks are about a third of credit provided in the private sector. In Canada and Mexico, it's somewhat less than half. Other countries, of course, it's quite a bit more. But that means that a narrow focus on the banking system, isn't going to have as big an impact as you might think on the overall credit. And second, could lead to, or B, could lead to arbitrage, that you have, if things aren't being done in the banking sector, then they're going to be done outside the banking sector. And so that's, I think, a concern with the narrow focus on putting pressure on banks.
If I could follow up just a tiny bit on that, that's part of the reason why the SEC's rule on climate disclosures is another place. It's obviously only going to get publicly traded companies, so once again, there's some fear of that. But those are two of the cheapest places to get capital, so that's part of, while I totally agree we need to expand, you start with those. You start with these spaces where it's banking and the public markets that tend to be the cheapest places to capital, and you start to integrate it, and it's true, it's scary in the short term that it goes somewhere else, but then my view is not that you stop there.
And if I could add one more to that, because I think you mentioned the SEC being broader. We haven't talked at all about accounting standards setters, and they have rules about the recognition of expected losses, and I'm curious actually, and maybe there's somebody here from the accounting standards community, like what are they doing with respect to climate? Because that's going to affect every firm, not just banks. And it would be really good to know.
So I think two things are really relevant here, and these are very important points you're raising. No? The International Sustainability Standards Board, the ISSB, is now being set up as we speak, and they're looking at these questions. Should climate fundamentally, the materiality we associate to climate is much the same way we had materiality associated to financial loss in the past, to the ISB. And so they're devising these in dialogue with industry. What constitutes materiality? How do you think about materiality? Is it climate, environmental materiality, or is it financial materiality deriving from climate? And these are big questions being discussed, and we're forging these now as we speak. And I think it's very important, because you mentioned the idea of data are available, they're just not usable often. And until we have a sort of standardization, ability to look at these, it's important. And they're also looking, interestingly, at machine processing compliant data, such that we can deal with very large data sets. No? The other point, I hate to open up another can of worms, but credit rating agencies are going to be key here. So banks, as we well know, they have internal models they can look at, the big banks in particular, on how to assess certain forms of risk. But a majority of smaller banks rely on credit rating agencies for standardized assessments. So the credit rating agencies are also going to be key in this respect. I don't think we call them shadow banks or non-bank financial intermediaries per se, but what they do and how they do it will be, I think, very important in informing the system on what constitutes risk and what constitutes risk materiality.
Yes, I know, I completely agree with you. The accounting standards, credit rating agencies, especially as Mark pointed out, that a lot of credit is now being channeled through non-banks. So they are definitely material to the system as a whole. But so let me ask again, relative to the set of issues that you've raised, is that we've had the evolution of a system which was bank-based. We had the development of markets. We then have now a system where the banks, the credit intermediaries, and the non-banks and the markets, plus derivative markets and insurance markets, are much more intimately related. So we used to think of bank guarantees as exceptional support because banks were special, they were closest to the payment system, and so on and so forth. And we have evolved into a system where, in the last 15 years, we've had state support, not just for banks, but central banks themselves have become liquidity providers of last resort. They've become market makers of last resort. And if I had described to you in 2000 that central banks would evolve in this particular way and that we'd be buying, there would be possibility that we'd be buying junk bonds to stabilize markets, it would have been unbelievable. So the question from a systemic point of view arises, given that's the structure of the system, where does it stop? I mean, that in some sense we're guaranteeing a bottom to markets, because they're so intimately connected to the rest of this really complex financial system, there is an implicit blanket guarantee that the upside is private and the downside will be taken care of.
I can quickly kick off. We've been doing work on contingent liability management. And I think the problem with systemic risk for us is that it ends up often in the hands of the sovereign, because it's an irresistible political temptation after a natural disaster to see who can help out. Well, let's turn to the sovereign and taxpayers. And there's certain questions where you'd ask taxpayers, it's legitimate that they cover things which are generally social losses, maybe in some cases. But somebody who is building a property in clearly unsustainably in places which were subject to high physical risk, it might be a bit of a stretch to say that the plumber in a given state should be paying higher taxes for this. So I think the question is, for us, ex ante, could you think about these insurance protection gaps? Somehow there's a question of insurers they have relative ease in dealing with systematic risk, so diversifiable risk, but non-diversifiable risk is a trickier kettle of fish. And so where we could see maybe public-private initiatives to better define ex ante the perimeter of support would help a lot ex post to obviating the need for exceptional public support on a case-by-case basis, which generates moral hazard and also, in the end, infects public coffers through all of this, which I think would be quite a malign outcome.
I'd reiterate as well that the regulations have become too weak. So if we're going to give this implicit guarantee, there needs to be a lot of requirements that come with it, rather than go take all the risk you want, make lots of money, no worries. Oh, but then we'll bail you out. So I'm not saying that we should necessarily do the bail you out, but we for sure need to make there be much more stringent rules on the front end, especially if we're kind of consider on the back end that we're going to be they're not the ones losing the money. We can't let them only have lots and lots of profits without a lot of oversight.
Great. With that, let me open up to questions from the floor. Remy, why don't you start?
So China is the world's second largest economy, and India is the fifth largest economy. It doesn't work?
I have the same problem.
Anyway, that works. Okay. So China is the world's largest economy, and India is the second largest economy. India is the fifth largest economy. We heard today that the US is not doing much. The Fed, maybe the Bank of England is doing more, and the ECB is doing more. What about the Bank of China and the Bank of India? If we can learn from them, what type of policies do they implement, and all that, because that's very important for the world as well. Thank you.
International coordination, international responses. Does anyone have anything to?
I could kick off. So Network for Greening the Financial System is now 121 countries. It's an enormously big an exercise. And through that channel, we're dealing with not only with China and India, but with a wide range of economies. The biggest range I could possibly think of. But through also the other channels, through G20, FSP channels, BCBS, Basel Committee, we are also dialoguing quite actively. And to be fair, it's 50% of global emissions emanate from Asia at the moment, 30% of global emissions from China alone. It's important to engage and act with them. And we've seen China and India very much embracing this, picking things up. So with India now, the G20 is in charge and has been very active in the climate space. China's been active for years, and we've had a lot of learnings from them. In fact, Dr. Ma Jun was in charge of one of the actual substreams and took a lot of quite innovative action in China. So to be fair, that dialogue is there. It would be a pity if the current fragmented political landscape were also dealing a blow to the climate cooperation, which up to now has been quite good. So that space is to be watched.
Two small things to add. One is that the US is behind, but it doesn't mean they're doing nothing. I do want to clarify that. We're way behind, but we are doing stuff. And the second one was, it was the Green Swan Conference almost 2 years ago, and it was actually a very big point of the questioner and Chair Powell and the head of People's Bank of China saying this is one of the few areas we can really work together. This is something that kind of, I haven't followed recently with Taiwan, but they actually view this as a place that they can collaborate and talk about things where they can't in other spaces, which is essential, as you describe.
And I'd maybe just add to your comment, Paul, about NGFS membership, the Basel Committee is also a forum for cooperation, and they're not ignoring climate, and China and India are there, so they're part of the dialogue.
Great. Francesco, you had go ahead. Please go ahead.
Yeah, thank you. So Sarah Raskin mentioned earlier that the SVB situation showed that smaller bank crises can pose systemic concerns. We have nearly 4,200 smaller banks in the US, many of which are in climate vulnerable areas. Paul, you mentioned that transition risk right now is dominant and physical risk will show up. But for these smaller banks, and I know you don't have as many as the US does, it's happening now, the physical risk aspect of those. Some of these issues are being masked by federal subsidies, state subsidies, but they're happening now for smaller banks. They don't have the same capacity. They aren't always assuming the risk willingly or creating the risk, while these larger banks are financing emissions, or larger insurers underwriting fossil fuel investments. So how do we achieve a more just allocation of risk, of financial responsibility in this context, in this situation, for these smaller institutions, which are incredibly important for communities that need it the most, need access to capital the most? How do we achieve a better allocation of risk and responsibility?
Well, maybe I'll start with that one. Yeah, I think it's a great question, and it's clearly it's a feature of the U.S. banking system and the financial system that's unique, right? There are all these banks. It also highlights the fact that a lot of the climate effects they're geographically specific and sectorally specific. My sense from talking to the smaller bankers that have the exposures is they're aware of it, and they have been, and to some extent, what can they do? They can't diversify away from their footprint. They're stuck with that, but they're not leaving those communities either, and so they're continuing to extend credit. And it probably just means higher capital requirements. Probably they should hold more capital to protect from the risks, because they are dealing with unexpected risks right now. And I think U.S. regulators are pretty plugged into that issue as well. Now, I don't know that they're approaching it. You seem to be approaching it more from an equity perspective, and I don't think that's how they're thinking about it. That comes up more on the community development side, and maybe we can talk about that more as we go in this.
Anyone want to add something, or next question?
Well, I'll add a little bit about the small banks. Also, trying to take what's best about small banks. And so you've talked about scenario analysis, which is a very useful tool for big banks, but smaller banks actually know their communities. Yes. So in some ways, they might need different tools that make it not as heavy lift for them to understand their risks, because I've been trying to kind of imagine a community, a local banker, that their brain is the scenario analysis. If you give them a little bit of data about what the weather patterns or transition risk are, they actually know that house over there floods 3 times a year. They kind of know that. So how do we start thinking about it in a different way when it comes to smaller banks that aren't saying top down, do this heavy modeling that's really hard for them, but build on the best of what they already know in their communities to help them then be prepared for when these disasters strike?
I could just add one sentence, because you mentioned what I'd said at the outset. What's true is I was talking, and I had the caveat maybe with the mic off, that I was dealing with the top-down system-wide questions. But these are the ones about how do you consistently look at climate risk. But there's a question about consistency, but there's also one about relevance. And relevance really is what you're mentioning both. These banks are all very different. And in their own communities, they're seeing things very clearly. And the dialogue cannot be just some ivory tower dictating top-down issues without having that bottom-up feedback. So both are necessary in addressing the risk, no question.
Thanks. Francesco, you had a question.
So we were talking about models. Models are metaphors. I like thinking of the financial system. I like this metaphor, the sand pile metaphor. So because it's a well-studied model in physics of self-criticality. Okay. Now imagine, so every now and then there is some sort of a slide. Sand falls on the pile and then there are slides. However, it can be modified, the model, if you think of dropping the grains of sand explicitly where you know or you are expecting no result, no slide, okay? So the final result is basically that you get fewer slides. That's the objective. However, the slides that eventually occur are bigger, okay? So out of metaphor, the story of the monetary system in the States, in the world at large, I would say, is that of trying to avoid financial crisis, avoid banking bankruptcies. So that led from the free banking system, if you want, into eventually the federal system and the greenback, and that's it, right? And then eventually, the legislation, I don't remember the names of these laws that were preventing banks from having branches across borders, across states, right? Which was abolished recently, quote unquote, recently. All these, it makes sense, perfectly sense in financial terms. You're increasing the pool, so the probability of having a tail event is smaller. But when it hits, it obviously much bigger, according at least to the simulations I've run. Okay, so the question is, we're aware of that, and so as much as in fire treatment, some would think of allowing actually some fires, natural fires, to occur to reduce the pressure on the overall system. It may be the case that supervisions or regulations may actually want to try to cut this network of relations between banks so that if there is a crisis, it is localized and it does not build up pressure for the full system. Do you think that climate changes this perspective, or it may actually still be valid on this? Thank you.
So let me summarize that question, because that's a very important question. We're dealing with complexity. And if I understand what Francesco is saying, is that are there structural solutions? That means, in some sense, can we create structural modularity that prevents contagion from spreading? And he's asking that question in the context of climate change. So this is a structural question, because I think this is a perfectly valid question to ask. And I'll give you the diversity. I think I saw somewhere the other day that the Dakotas have more banks than Canada. But anyway, we can think about that later.
That might not be true.
So there you have it.
Should I give it a quick step?
Anyone who wants to start? Yes.
Well, okay. Yes, go ahead.
Okay, no, I could just say quickly, there's always been a tension between, sparse versus networks versus other types of networks. In risk propagation, on the one hand, you have to trade off against the idea that you could have risk diversification or risk sharing. So in a sense, I think diverse systems also tend to be more resilient. So I think to come with a simple prescription, we should have effectively more sparse systems. I'm not sure would be a better proper policy proposition. You need a balance, a fine balance between the two. I think what's clear, what we learned in a global financial crisis, I think it's not worth forgetting this, is interestingly from natural sciences at the time, we were learning a lot about how they deal with these types of phenomena, contagion, propagation. And one of the things in the forest fire world, so then again in the environment world, was they were looking less at the fact that sparks always come. You'll always have sparks. It used to be that forest fires, there was smoke, don't smoke and drop your cigarette butts, or light fires in fire-prone areas. But with time it became more, let's have circuit breakers. Let's have actually controlled burns of parts of forests So when the fire actually does come, and it may come for a variety of reasons, it doesn't spread. So again, you can have a network which has the risk-sharing elements, but maybe some circuit breakers which also minimize the element of risk propagation should and when it occur. And almost always it does occur at some stage in contingent basis.
Well, first, there's an Alan Greenspan quote that the optimal number of bank failures is not zero. I think it's a healthy thing for a banking system for there to be bank failures, and so we shouldn't try to design a system that has none. I would think, rather than trying to sever connections to change the way the network of the financial system, there's a traditional supervisory tool of concentration risk management, and that really a lot of what we're talking about with climate is another example of concentration risk. The reason I like to frame it like that is because then we can port over an existing supervisory and risk management framework into a new area and start saying, okay, if we view this as being like concentrated exposure to a single large borrower or a concentrated exposure to commercial property, no, it's climate, and now let's think through the implications of that. I think that's going to be more productive, and I think it's something that we can do in the relatively near term, and that banks will be able to get their minds around.
Any other questions? I have one last question. Is there a question? Oh. Please.
Thank you. I'll ask it. It's a broad question, but I'll throw it out there. I'm wondering, we're talking about risk management and presumably risk minimization, but whenever you're engaging in that, there's always an opportunity cost. You're going to direct a certain amount of resources towards the risk management versus some other utilization of those resources. How does one factor that in within the framework of central banking mandates that we talked about earlier? In other words, to give a anecdotal thing, I may have a small shack at the beach, but they tell me flood insurance will be $25,000 a year in premiums. I make a decision that I'll let the shack go if there's a hurricane that comes through. How is that factored in to a banking situation? It's almost a political resource allocation kind of balancing. Thank you.
To go on that specific example, it also depends. If you have a shack that you own outright, that's very different than you have a loan on it. If you have a $200,000 loan on it and you've chosen not to insure it, now that becomes a problem that becomes for the bank. So I think that's the piece where we also have to be clear. If you are saying that as soon as it washes away, my losses go to someone else, then that kind of makes sense to be included in the system. And yeah, it takes some effort. But if it's just yours and you're like, I'm fine, I lose it, then that's a different calculation. So I think it kind of has to be those sorts of things of like, is your choice going to maybe take a bank down? Or is it just you're going to lose the money?
That's good.
Okay, so one last, this is a quick fire question. Any thoughts on the institutional organization of Macro Peru in the context of climate change? How post global financial crisis, countries basically created an overseer for systemic risk, and institutionally it was quite different in different places. Do you have any thoughts on how, given that we are facing a climate crisis, do you have any thoughts on institutional arrangements?
Maybe it's an opportunity to reduce the number of bank regulators in the U.S.
That's a good thought.
I think the international cooperation angle is key. So a lot of the global financial crisis aftermath was establishing regional bodies looking at systemic risk, which are rather encompassing. So the FSOC here, the European Systemic Risk Board in Europe, and elsewhere. But I think in this case, it's really now, if any time you need an international cooperation, it's on this topic. I mean, small island states are subject to high physical risk. Small countries are emitting quite a bit of carbon. I mean, they need to be talking, no? So I think this is key, that this is a clear case for international cooperation. And unfortunately, it's going the other direction at the moment in some respects.
And I'll add in, referencing some comments that others have made, especially about insurance, that ours needs to get bigger. We need to think about this financial regulations in that way, that you cannot, so in this example of SOC, perhaps making things SIFIs, as Sarah Bloom-Raskin mentioned, et cetera, is an important point that we aren't really, that we need to use those bodies to think of this in the big way that it is for the financial system, not like narrow banks, but that broader one is something that we need to do with these institutions.
Great. Thank you so much, and let's give the panel a big hand.
Thank you so much.